me cabe ahora la tarea de presentar a Ylmaz Ayküz, que casi que no necesita presentación. Él no solo es el economista jefe del Centro Sur, sino que lo fue antes de la Conferencia de Naciones Unidas para el Comercio y Desarrollo, UNCTAD, en Ginebra. Desde ese cargo fue durante muchos años el principal autor del informe sobre comercio y desarrollo que se publica anualmente, o sea que ha observado desde una posición privilegiada los temas sobre los cuales hacía referencia Porto, y además es catedrático en varias universidades, en Turquía, su país natal, y en otras capitales en Europa y en Asia. La bibliografía publicada es extensísima. Cabe destacar, entre otras cosas, que Ayküz fue el primer economista que señaló la necesidad de un mecanismo arbitral de solución de los problemas de la deuda, de la deuda soberana, y ha estado discutiendo los temas de las finanzas y la situación financiera actual en estos días por toda América Latina, pero hizo especial atención de que en Uruguay le interesaba profundizar otro tema que no deja de estar relacionado, pero que es de particular importancia para nosotros, que es el tema de la inversión extranjera directa y la industrialización. Ayküz, tiene la palabra.
I'm going to speak about foreign direct investment and industrial development. There are two reasons why I do it at this juncture, because this is an issue that's been standing with us for many years, and we did a lot of research on that in UNCTAD too, and I was in charge of research in that institution. One context is that this BIT, bilateral investment treaties, now have becoming a headache for many developing countries, with transnational corporations that started suing governments for millions and sometimes billions of dollars. We have seen in Argentina, South Africa, India, I think in this country too, Philip Morris. And that's becoming a problem, and many countries are thinking whether they should try to get out of it or simply stay with it and do what the agreements call for with the TNCs. The second reason why I want to do that is that we have recently the spread of the so-called global value chains or global production networks, which are organized by transnational corporations from the major industrial countries, United States, Europe, and Japan, and in which developing countries participate in certain processes of the production of a final good, which is often destined for consumption in the, there you have. In the, excellent, thank you. In the industrial countries, and now, in fact, OECD, WTO, World Bank, all now jumping to this as an engine for growth. In a way, you either participate in global value chains or you perish, and therefore it is replacing trade as an engine for growth. Of course, jumping in global value chains implies not only liberalization of trade, but liberalization of almost everything else. Investment, government procurement, competitive policies, trade in financial services, and everything. So what I do is I look at the experience with respect to foreign direct investment, and particularly drawing some lessons from successful countries in East Asia which used and attracted good FDI, and offering it to countries who are they attract foreign direct investment, new plants and equipment. It is what we call greenfield investment. But there is no correlation between really whether a country attracts greenfield investment and the country has BITs with the host countries. In fact, many countries which attracted useful greenfield investment had no BITs China. BIT is bilateral investment treaties that the developing countries sign with industrial countries, which put them under obligation with respect to treatment of foreign companies. Now, these BITs are governed by corporate perspective. Corporate perspective meaning that anything you put your money in is investment. Clearly, this is quite different from the social perspective and development perspective, where investment is socially productive capital. So what is an investment for a corporation or individual may not be necessarily an investment for the society as a whole in terms of producing, increasing production capacity. Naturally, as a result, BITs incorporate provisions, not only FDI, but many other things I have already mentioned, including free flow of capital, international flow of capital. This actually worried the IMF in its latest pronouncement of the official position of the fund with respect to capital controls. Fund notes that these BITs and free trade agreements include provisions that give rise to obligations on capital flows. That's any kind of flows. And most of these obligations do not take into account macroeconomic and financial stability. And IMF continues to argue that they do not allow for the introduction of restrictions of capital inflows in the event of balance of payments crisis and restrictions over destabilizing inflows. So IMF said that countries should take it into account IMF positions with respect to capital control before signing BITs, because many of the IMF recommendations will be excluded or will be illegal under BITs. Now, looking at the mainstream idea under FDI, FDI is an engine for growth. Of course, it's now the production networks focusing on TNCs and FDI. It supplements domestic resources, provides balance of payment financing, adds to productive capacity, brings technology and raises productivity, and is a stable source of finance. Any of these statements is controversial, highly controversial, and I will take them one at a time. The contribution of foreign direct investment to stability, growth, and development is vastly exaggerated. In reality, there is hardly any country which has developed on the basis of foreign direct investment, although a number of countries have used it as part of their national development strategies. But to be able to use that as part of national development strategies, they had to have considerable policy space, not constrained by provisions in the BITs. Now, starting first, what is FDI? There is considerable ambiguity, what it means in practice. In fact, what statistics, which call themselves FDI, we don't know what they mean. Now, FDI actually is meant to be direct equity investment to acquire a lasting management interest, at least 10% of voting stocks in a new or existing firm. The foreign company going into a new investment with a domestic company with at least 10% is SDR, or taking 10% of the existing company, 10% and more is called FDI. And below 10% is considered as portfolio investment, not foreign direct investment. This is the standard definition used by the IMF. Now, this distinction is totally arbitrary. Why 10%? Why not 11% or 9%? Much of the FDI is acquisition of existing assets. In 1999, in this region, it was mostly privatization of public enterprises. And now you also see the foreigners acquiring private companies, banks, and others in these countries. The second source of FDI is profits not remitted to shareholders of TNCs. So a company makes profits and they're not remitted and sent abroad, but remain in the country. Now in the balance of payments, this is registered as an outflow on the current account and inflow on the capital account, on the presumption that it will go into FDI as conventionally defined. That is in plant and equipment or acquisition of management interest 10% or more. But in reality, we don't know where this money goes. There is existing statistical practices do not actually allow us to say where the unrequited profits go. This is important because a very large proportion of registered FDI is unrequited profits. And this proportion is more than 50% for the United States foreign direct investment abroad. So that money might have just as gone into government bonds. There is no way we can, in practice, say what is really being happening to this. And third source is the loans between the affiliate and the parent companies. And again, this is considered as FDI. If you look at the sectoral pattern of FDI, most of the firms acquired in developing countries by transnational corporations are in services and public utilities, very little in manufacturing and industry, mostly banking, insurance, telecom, water, electricity, transport. An important part of greenfield investment, new plant and equipment, is also in so-called non-traded services sector, except in countries closely integrated in international production networks such as China, where foreign direct investment goes either as a joint venture or full ownership into new plants and equipment in export sectors. Until recently, there was very little FDI globally on natural resources in the developing countries. But with the emergence of China, we have seen an increased investment, particularly in Africa and Latin America, by China, India, and as well as some companies from Europe and United States into natural resource sectors to guarantee supply of oil, minerals, metals, and in some cases, some biofuels. Now, stability. One argument is that FDI is highly stable. Now, again, we don't know. Because existing statistical measures cannot distinguish between the use of retained earnings for investment or for other purposes. Okay? Therefore, it's difficult to evaluate the stability of FDI. Now, we know that the so-called portfolio equity, which is under 10%, is highly unstable. Then why 11% should be more stable? Now, most of the mergers and acquisitions are driven by prospects of quick windfall profits, and they tend to be much less fixed than new investment in plants and equipment. And even greenfield investment could be highly footloose. 10, 15 years ago, if you went to Malaysia and the island of Penang, you would see many transnational corporations in light electronics manufacturing. Now they all left for China. They left for China. Again, many companies in continental Europe left for Ireland and other countries providing incentive for FDI. Now, the link between FDI and gross fixed capital formation, that's the investment as we know it. Again, there is no one-to-one correspondence between FDI and gross fixed capital formation. If FDI is in mergers and acquisition, it does not necessarily lead to an increase in productive capacity unless the new firm makes some rationalization investment, restructuring. Second, there is a possibility of crowding out domestic investors. That is, particularly when you give incentives, you may actually prevent domestic investors coming into the sector, and this is happening quite a lot recently in Asia. Now, there are conditions when domestic investment can collapse, if gross fixed capital formation collapse, and you have a huge inflow of foreign capital. We saw that in Asia after the crisis in 1997, when stock market collapsed and many firms from United States and Europe went into Asia for what we call fire sale FDI. That is to grab cheap companies in Korea, Indonesia, Malaysia, at a time when there was no investment in the country. And finally, if you look at the movement of the FDI and gross capital formation globally, and I made a comparison, a paper between 1980s, 90s, and 2090s. In the 1990s, when Latin America went for liberalization, gross fixed capital formation was unchanged from 1980s. But the share of global FDI in GDP increased by 5-fold. So it was basically reshuffling of global ownership. FDI was actually reshuffling of global ownership rather than creation of new productive capital. And this is continuing in the new millennium. Next, what's the impact of FDI on balance of payments? We have two measures. One measure is the so-called net transfer measure. That equals FDI minus inflows, FDI inflows minus payments abroad for profits, royalties, license fees, wage remittances, and interest paid on loans to the main firm. So it's effectively what's happening to transfer FDI coming in, payments going abroad. Now, originally, this difference tends to be positive when inflows are large and outflows are small. But over time, as inflows come in, stock of foreign ownership gets bigger and bigger, but the pace of inflows slows down, and gradually, income payment starts taking over the inflows. We saw this very clearly. In Malaysia, net foreign direct inflows between 2000 and 2007 were 137 billion, and outflows of payments around 250 billion. In other words, the FDI that is coming in is not enough to finance the income payments to transnationals abroad. And in fact, today, if you look at Brazil is a huge outflow of income payments. Brazilian trade deficit is not that big, but Brazilian current account deficit is very big because of, one, interest payments abroad, two, profit remittances. The second measure is to take into account what FDI does for imports and exports. Okay? Now, that is, foreign companies import, they also export. So to take these as well as the net transfer into account, the outcome depends very much where the FDI is. When FDI is concentrated in non-tradable services sector, generally the impact is negative. Balance of payments is negative. That is, you have to find and generate foreign exchange somewhere else in the economy in order to pay out the net imports and the profit and other remittances for foreign direct investment. When FDI is in tradable goods sectors, they may be either substituting imports or exporting. In that case, it also depends on the extent of they rely on imports, on the extent they are export-oriented. Now, if FDI is market-seeking, what we call tariff jumping. This was quite popular in this region in the 1970s when tariff barriers were very high. So therefore, American company could not export to Uruguay or Brazil. Instead, they came here to produce and sell in domestic market. This is called tariff jumping FDI, which has become much less important since the Uruguay round with the liberalization of tariffs. In this case, the imports are quite large, exports are very small, and the impact on balance of payment is negative. Then FDI in production networks. People look at China and say, look, Chinese foreign direct investment is export-oriented. Can we do that? Now, yes, true, Chinese foreign direct investment is export-oriented. But one thing is the import content of those exports are very high in China. I have some papers which you can find on the South Center Network website. Fully foreign-owned enterprises in the export sector have the lowest share of domestic value added in exports and the highest share of imports in their exports. 80% of total exports to the US and with an import content of 60%. Now, on top of it, the remaining $40 is value added. But the $40 value added is part the wages, part the profits, and part the taxes, which is not really very much. So if you look at the profits, what happens is that China earns $20 from every $100 of exports to the United States. Let's skip that. No, before. Now, since balance of payments impact is often not very favorable, since FDI usually involves a very high rate of return, 20-25% for foreign companies, you should get some additional benefit from FDI, okay, in order to use them. Now, these benefits are technological spillovers. That is, you take the transfer of technology, know-how, organizational skills, access to foreign markets, and spillovers to domestic firms, employment of local people, all these things that countries would like to have. But these things do not necessarily suit the foreign companies. Why? Because transnational corporations' main advantage is monopoly over such know-how and technology. And the moment they start freely passing to everybody else, they will not have anything left to earn extra profits and rents on this one. So it is against the profit motive and global strategy of transnational corporations to pass on to the countries the skills, know-how, technology freely, okay? And therefore you have to really extract it from them. You have to have extracted from them. That means that if you have a laissez-faire approach to foreign direct investment, you won't get much technological benefits. Right? You need to have active policies forcing foreign transnational corporations to pass such skills, to use local produce, to use local labor, to involve domestic firms, pass skills and technology. Looking at all these, I have 9 lessons that we drawn from the research on FDI. First, please pay attention to the balance of payments impact of FDI and take a long view. Developing countries are often balance of payments constrained countries. And governments have short-sighted. They're short-sighted. They look at the time when the money is coming in. They don't look at what's going to happen in 5-10 years' time when these guys start earning huge profits and not bringing so much in. So a permanent continuity in bureaucracy is important in that respect. Governments are not continuous, but bureaucracy can be continuous, as in Korea and Japan, that can take such long view. But please take a long view on the balance of payment of SPR, of FDI, and have a balance sheet for FDI, for Forex balance sheet for FDI, what they bring, what they take. Second, successful countries never use FDI to meet balance of payment shortfall. That was never the idea in Korea, in Taiwan, in Japan. They never looked at FDI as a way of financing balance of payment deficit. And moreover, successful countries did not have lack of domestic investment. They had very high investment rates. Okay? So they didn't think that FDI is to replace, take care of the lack of domestic investment. In Korea, investment rate is 40%, 45% of GDP. In Korea, never, in China, sorry, in Korea, it never fell below 25, 30%. China, 45, 50%. Now, Brazilians have 16% investment rate. Why should any foreigner invest in Brazil if Brazilian capitalists don't invest in that country? Okay? So investment, foreign direct investment, is not a recipe for lack of investment in the domestic economy. Third, you should encourage greenfield FDI, but not in every sector, selective. Selectively encourage, and greenfield takeovers and mergers can be justified on a case-by-case basis, but in principle, the idea is to get new productive capacity. And even in the takeovers, it's important to force the foreigners to make new investment for restructuring. Third, go for joint ownership with local firms and pay attention to crowding out. Make sure that this investment cannot be made by local firms because of lack of skills, know-how, etc. But even then, go for joint ownership with them. And in fact, my country and most others in Asia went for joint ownership. And this is why many of the foreign automotive firms are more successful under joint ownership than full ownership in exporting with little import content. Fifth, no strong incentives unless significant technological spillovers. If you're giving incentive, it has to be reciprocated. It has to be delivered. Delivered in terms of technological skills, etc. Again, imposing conditions to secure spillovers, employment of local people, local procurement. One of the interesting things we found out in UNCTAD, and we weren't expecting this, in this respect, U.S. transnationals were more benign than Japanese. And this was a puzzle to us. And then we tried to explain why that U.S. transnationals are less linked to the U.S. and more linked to domestic economy than Japanese. U.S. transnationals were global players. Japanese were not global players. They were looking at the center, bringing people from there, bringing parts, components from Japan, and looking at Japan. And they were never really, a firm in Malaysia was not connected with a firm in Turkey or in Uruguay. Whereas in the case of US, they were all connected. So it doesn't mean that US is better than Japan, but in this respect, we found that US firms are more benign in domestic linkages than Japanese firms, although many people would think the other ways. And 7, Korea nurtured domestic firms to compete with foreigners. Don't leave the sector to foreign firms alone. And Korea eventually, today, produced Samsung, Kia, Hyundai, which is better than Japanese firms, and even better than American firms like Apple, Samsung selling 5 times or 4 times Apple. Now, linking to international production networks. Many people think that, as I said, you either link to networks or you perish. China is seen as a good example. It's true, but jury is still out in China. But look at the other countries like Malaysia, Thailand, Philippines, which were linked to international production networks. I think they are all trapped in the middle income trap. They are not able to move technologically further. These countries are squeezed between Vietnam and China coming from below, and Korea, Taiwan, and Japan from above. They cannot compete with those at the above, and they cannot compete with those from the below. And therefore, they still depend on import of capital goods, intermediate goods, and they lack diversified manufacturing. In my paper on that table, I estimate that 50% of Malaysian exports are in commodities. And that's a country which is supposed to be manufactured, industrialized country. Finally, don't expect to achieve rapid growth by getting FDI. You only get FDI if you achieve rapid growth. Finally, policy space. Do we have enough space for national policies to do all that? Now, of course, in WTO agreements, which started in this part of the world, the investment measures, trade-related investment measures, constrain policy space in developing countries in many respects. But nevertheless, I've written a paper called Policy Space, which is published by Third World Network. There are many ways of going around the ground commitments in terms to encourage, to force foreign firms to benefit the country in terms of spillover and other things. But the real constraint comes not so much from WTO regime on TRIPS, but from BITs and FDIs. And this is where companies start suing countries. And therefore, I would suggest that we'll have significant potential benefits in getting out of BITs, bilateral investment treaties. Doesn't mean that you negate or you're hostile to foreign direct investment, but you simply want to widen your policy space so that you can use foreign direct investment as part of national development. I should stop here. Thank you.